Hello, this is Kevin Prince from BMO Exchange Traded Funds. Thank you once again for joining us in the Market Insights webinar. We try to give you some insights towards the exchange traded funds. Each week a different topic. And we're going to quickly talk a little bit about disclaimers. If you come to these sessions, of course, you know by now that we're not going to give you specific advice or specific recommendations. Our goal really here is to help give you education and just insights towards the market and specifically to the tilt around ETFs. Now, I'm really looking forward to the topic today because our topic today is all around the ETF Outlook Report. That's something we as BMO ETFs put out once a year, and it's really picked up in the media and different sources. My guest today, Mark Reyes, has been with BMO ETFs, and specifically BMO Global Asset Management, for 11 years plus, but actually the author of the report himself. So I'm really looking forward to picking your brain and just picking up some of the nuggets, what you're seeing as the trends towards in the ETF space over the next year. Before we go into the actual ETF Outlook Report, what we want to do today is always start off with some tools. So here's a net new tool for the audience. The FinIndependenceHub.com is a website to take a look at. If you've ever read the Financial Post and you know of Jonathan Chevreau, this is his project out there, where he goes and talks about different topics in a little more detail, stuff we're not often covering, like GameStop there, if you see on the screen. But in addition to that, he has various blog writers on there too, and blogs that go back to 2014. So take a look at it. In fact, actually, the website relates to a book that he wrote a number of years ago. You could even pick up the book with inside the website too. So take a look at it as another resource for you to get further insights of the broader market out there. With that, Mark, let's get into the topic for this week. We're certainly going to talk about, to start off with, the flows within Canada, because that's part of the things you're looking at when you do an outlook is where do we see flows from last year as a trend to go into flows to next year. So give us some thoughts on that to start off.
Sure. Thanks, Kevin, and thanks to everyone for joining again today. We appreciate you listening in. So, right, let's take a look at flows, because that can certainly tell us a few things about what the market is thinking, what we're all thinking about as investors, and as well where we might be going. So the Canadian ETF market, another record year now through 250 billion, about another 40 billion coming in, and we can see where the flows have been going. By and large, we've been getting a pretty even split over the year between equity and fixed income, which is quite interesting because when you consider the market returns, obviously in the last 3 quarters of the year, you would have seen that start to twist back towards equity as people became more confident in the market, whereas fixed income, people using those being positioned more defensively. But a reasonable split between the two, which is telling us that people still want that market exposure that the ETFs can provide. The other one I'd highlight is just the slow and steady rise of the multi-asset ETFs. So multi-asset just meaning balanced. I'm sure we're all familiar with balanced funds. This is a relatively newer thing in the ETF space, really only the last few years that balanced ETFs has started to take off. But people are seeing the use of balanced ETFs as core positions in their portfolio, low cost, diversified exposures that really make sense as a starting point within your portfolio. If we then look down at geography, looking where all the flows have been going, no big surprise. The big winner was the US. If we think about returns in the marketplace last year and those new economy names out there that have really dominated returns, those new tech names, you're going to find most of them in the US. So it's not a big surprise that a lot of flows have gone that way and continue to go that way. And one thing I'll pause on just really quickly before we move on is, the growth of the industry, while of course it's good for us as providers, it's also really good for yourselves as investors. Why? Because it gives you more choice, and as the industry grows, people can feel more confident launching products that are maybe a little bit more specialized, knowing they have a better chance for success. And so I thought you really saw a lot of that through the last year, where a lot of more innovative equity type exposures came to market to help people capture growth in their portfolios. So as much as we turn around and are thankful for the growth in the industry, I think it's important for investors as well. Thanks, Kevin.
Well said, Mark. Now, going into your report, one of the key things you touched in your report is, kind of the growth of thematics and back to your point, accessing that growth part of the marketplace now through ETFs. Maybe give us a thought, what is thematics? Because maybe that's a newer term for some people out there, but also talk about what you're seeing in that trend in that area, if you can, please.
Sure. So thematics is about finding a top-down trend in the marketplace, like disruptive innovation that really becomes, a point of investment. And the term we've been using quite a bit, and we've seen the market use, is mega trends. So you think of things like aging, or you think of things about clean energy, or you think about genomics or things of that nature, things that are really going to drive what's going on in the economy and therefore the market for years to come. And it's all about being positioned for the long term for those transformative themes to really play out across market returns. And it's interesting, if you look back to last year, the top 10 best performing ETFs were all exposed to thematics, with clean energy really dominating the list. Come back to Canada, where there wasn't any clean energy ETFs, there are now, including ourselves with our ZClean, ZCLN. You see a broader variety, genomics, AI, blockchain, etc. But those themes dominating returns as compared to the more traditional investment strategies that are out there. So this area has captured a lot of interest. There are a few providers that have come out in this space. Of course, BMO just came out with its innovation suite last month. 5 tickers that really represent well in this marketplace. But there are, of course, others out there, Evolve ETFs, Emerge ETFs. And the one that we might know from the US is ARK Investment, which has really been one of the most talked about ETF companies in the world this year, just based on the returns on their ETFs. So a really interesting way to add growth to your portfolio. So I'd really encourage everyone, if you're in a growth scenario, to really think about looking at thematic ETFs. Thanks, Kevin.
Just stay in that trend one more time, because you mentioned growth, and I think that's an interesting concept. Maybe partnering with a core holding, or how do you complement core holdings with these thematics? Maybe give a little insights around those.
Right, and I think when they first came out, people thought of them as quick or tactical trades that you jump on something and it goes up and you get back out. I think of it more strategically, that this can really be a growth sleeve in your portfolio. I think most are familiar with the Nasdaq Index. Nasdaq had a phenomenal year last year, returning somewhere in the neighborhood of 45% Canadian terms. That's driven by thematics, by and large, for Nasdaq in the technology space. Of course, that index is a little more diversified. So some of these newer things, like this MSCI Innovation Index, is a little more focused on those innovation strategies, and therefore you're even more exposed to that thematic. So for me, it really is something, if you compare it to the TSX here in Canada or the S&P 500, it just gives you much more of a growth slant, so it can be, a core strategic position in your portfolios.
Thanks for that, Mark. Now, shifting gears a little bit here, taking a look at your report, another key thing you highlighted was the ESG. Of course, that's the environmental, the social, and the governance aspect, and starting to see that becoming more of a key trend or theme out there. Walk us through that a bit, if you can.
Sure, and I think there's been a real explosion of products in the last year or two in this space, responsible investing or ESG investing. I think we're all becoming much more aware of the importance of thinking about things through this lens. I think it's bled into politics and of course how we lead our lives, and it's becoming very much more front and center in how we invest. So it makes sense. If I look back at last year, by and large, ESG strategies or indexes or ETFs outperformed the broad market. So that's another support point there. They can be used as core portfolio positions or as satellites if you want to start to introduce it into your portfolio. I think what you're seeing from ETF providers, ourselves included, is coming out not just with one or two products, but a suite of products to really help you invest with an ESG lens, and that's really important. It's not just a token exposure. BMO's put out some equity exposure ETFs, including global equity, some fixed income exposures as well. But I think most interesting, a balanced exposure, 60-40 balance under the ticker ZESG, which really is a one-stop shop for ESG investing. Thanks, Kevin.
Mark, I think you're right. That's interesting. You're talking about portfolio construction, how it's involved with an ESG lens. Another thing you mentioned in your report was about factors and factor rotation. That's kind of portfolio construction with what we like to call smart beta in the industry. And interested to hear about the rotation you're starting to hear in that space. Give us some thoughts on that.
It was a really interesting year for factors, Kevin. A real divergence of returns. Of course, we all sat there and focused on the market correction in March, but if we look beyond that to when the market started to rise again, I'm not sure that everyone realized that the returns were that concentrated. It was really being driven by these new economy names, and the more traditional or value names or even some of the dividend names were getting left behind. So when you look at the market, dividend, low vol value certainly trailed the market, while quality, represented by our ZUQ, really outpaced the market, again, by capturing more of that technology and the new economy names. And then, into the new end of the year, when we saw, of course, the good news on the vaccine front, that there's some potential that 2021 at some point will start to return to normal, you started to see those underperforming factors lift back up and start to close that gap a little bit. So we'll see what 2021 holds. Certainly the initial vaccine rollouts haven't been that promising, but you are seeing a bit of a normalization now between the factors.
Thanks for that. And I think that's interesting because it still keeps going that portfolio construction and new ways of using ETFs and rotation among factors is certainly something we're seeing. Mark, looking back to 2020, we always had some conversations before that about fixed income itself. And, people had questions about how fixed income would behave in these markets. Give us some thoughts on that. And I think what we're seeing out of this is that, to your point, we're seeing a lot more growth in fixed income. I think it came through solid, and that's why we're seeing that growth. So give me some thoughts on the fixed income space, please.
Sure, thanks, Kevin. And March was a very challenging time for fixed income. Anyone that holds bonds directly would, have a flashback right now and remember that period where essentially the underlying bond markets really froze up. In other words, the trading volumes dropped significantly, even to the point, keeping in mind these are OTC, so over the counter, they don't trade on the exchange. The quotes on the bonds themselves were drying up. So you were really not seeing any activity in the underlying bond market. But the ETF market, the ETFs of fixed income, continued to trade. So there was an ability to find liquidity when you needed it, right? So if someone wanted to quickly rebalance, they could do so with an ETF, where they really couldn't with the underlying bonds. And there was a bit of noise because the market price of the ETF was moving away from its NAV. That's because the NAV was frozen. So the market price of the ETF was actually the more accurate reflection of what was going on in the market. So it was a period of time that the ETFs provided the liquidity when investors needed it. And so therefore, it's a real proof point to the value of fixed income ETFs. And what we've seen out of that is just a higher adoption of people saying, you know what, these ETFs make it easier for me. I want to trade my fixed income through ETFs, which trade on the exchange like a stock. Thanks,
I think we're definitely seeing that trend. The other one that you touched on in your report is certainly the ongoing or the net new discussion with all the support that's coming from the marketplace here from the Fed and the works is the conversation around, inflation. That conversation picking up. Give us some thoughts around that as a consideration on a go-forward basis?
Right. Well, we're certainly not looking at elevated inflation right now. I mean, quite the opposite. When, of course, the economy is still struggling, inflation has actually been very low in 2020. But if we look forward, with all this monetary stimulus out there, with the expectation that the economy itself will start to pick back up, but with all the supply chain disruptions and the extra costs that are going to be embedded in products, you know, there's a view that inflation is going to be on the horizon. The other big thing in 2020 around inflation was that the Fed, the US Federal Reserve, came out and said, you know, they're going to be less worried about capping inflation at 2%. They're going to be more about targeting 2%. And that, believe it or not, is a big difference, because that's basically signaling to the market that they will allow inflation to go up above the target for a period of time. So all that together kind of makes a lot of people, a lot of investors start thinking about inflation down the road and potentially pre-positioning the portfolio, you know, by buying potentially some inflation protected bonds on the fixed income side to really balance out some of the erosion of the coupon if inflation was to start to pick up. So it's going to be a good thing to keep an eye on. It's clearly not here yet, but there are signs that it's somewhere around the corner.
Thanks for that, Mark. Now, you know, maybe give the listeners here a little bit about a direction where you're seeing the path ahead for the ETF industry and some thoughts around that, please.
Sure. Well, I kind of mentioned near the top the importance of the growth of the industry, because it allows providers and investors to really access new and more niche ETFs. I think that's going to be a key part of the market going forward, like these thematics that we've talked about, to find new ways to invest, give people new tools. So I think that's really important off the get-go. Of course, you don't forget about the broad exposures. Something like our ZSB, our S&P 500, is still a core holding for portfolios, and that's across user types, you know, directly from ourselves as individual investors right up to institutions. So I think the market itself, between broad and more precise ETFs, is really in a good place. The market is going to continue to grow. You know, here in Canada, we're at about 250 billion. That's going to more than double in the next 5 years for sure. But if we look at the industry itself, you know, we think that it's quite critical that you work with someone that provides that support, that education you need to really understand the market and what the ETFs are. As there gets to be more and more of them, it starts to feel more and more like the mutual fund industry, in that there's a lot of choice, and the biggest challenge is picking the right one. So getting that education, like these events that Kevin and Prosper have been running here, is really critical to understand the market and help to pinpoint where you might want to go in the ETF marketplace. Thanks, Kev.
Thanks for that, Mark. Now, for the listeners out there, if you want to have access to Mark's report, just released, I think it was released earlier on this week, Wednesday. All you really simply need to do is, you know, Google the ETF Outlook report, and it'll come up for you right there. Or you can go to the BMOETFs.com website. It's posted on there too. But if you want to dive in a little more detail on the topics we just covered today, absolutely, we say take a look at the research itself in real time. With that, let's shift gears. We got a number of good questions in today, and I thank everybody for taking the time and effort for sending questions in, because again, that drives our core content for these sessions. In fact, actually helps us see what people want to hear from us on a go-forward basis. So thank you for taking the time to do that. Mark, let's jump into a number of questions. I'm going to start off with you and talk about, you know, let's say somebody's starting out, they got $1,000 to invest. Where do they go? Now, this says give us advice. You know, we're not going to give specific advice, but can you give us some general thoughts around, you know, I got $1,000 invest. Where do I start?
Sure. So absolutely, I can't tell you or advise you how to invest, and certainly suitability is critical in understanding something beyond just how much an investor has to invest. However, assuming you're looking for a portfolio type solution and perhaps perhaps a bit younger, so looking for something that provides a little bit more growth, I'd start with a balanced ETF. So the first one that comes to mind on our shelf would be something like our growth ETF, so ZGRO, and that's about an 80-20 equity fixed income split. So it's a real core position for your portfolio, but again, gives you that equity growth over the long term. If you're someone who's more focused on, let's say, ESG or responsible investing, our balanced ETF in the ESG space, ZESG, might be something that you look at. Or if you're someone who's just looking to invest in equities for the long term, can handle more risk, really, let's say, just getting started in investing with a very long-term time horizon, something like the S&P 500 or ZSP is a great starting point to build your portfolio, or even something like our global quality if you want a more diversified exposure. ZGQ is a great ETF to look at as well. So again, it really depends on your own individual scenario as to how you need to invest and what you're investing for and what your timeline is. But clearly, ETFs provide those core building blocks to put a portfolio together. Thanks, Kevin.
And what I like about that too is the amount of diversification one gets by placing $1,000 across all those securities you just mentioned and different choices, right? It's a very diversified approach. Mark, let's stay on that theme because somebody has a question specifically around the ZBAL ETF you just mentioned a second ago, and taking a look at that 60-40 asset allocation, equity fixed income. When they're saying that, what's the rebalancing? How often does it happen? What's the the rails around rebalancing?
Sure. So our asset allocation ETFs are strategically rebalanced, which really means we don't have someone behind the scenes making bets saying I think equities are going to outperform bonds or vice versa this quarter. So they rebalance back to their 60-40 weight. We do have a band around that, so plus minus about 2.5%. So we do allow the winners to run a little bit, but at the same time we're disciplined about the strategic rebalance that on a quarterly basis we look at that to bring it back within that tolerance. So it's not something that if equity markets outperform for 2-3 years running that you're suddenly going to move to 75-25. You're going to stay in around that 60-40, and that gives you the disciplined core for that portfolio. Thanks, Kevin.
Thanks, Mark. Here's an investor after my own heart looking for fixed income that pays 8 to 10%. Is there anything coming out in the near future around that, Mark?
Sadly, no. That's a reflection of the fixed income market, not necessarily a reflection on ETFs. ETFs just invest in the bonds. But by and large, when you're seeing market yields 1%, 2%, 3%, if you are an investor that's targeting a higher payout, inevitably within fixed income, you're going to be getting some element of your investment return to you via return of capital. So, you may go for a higher payout series, or you may need to sell part of that ETF over time. But that's going to mean that your investment is shrinking over time. By and large, if you are targeting a higher return over time, you're going to have to increase the risk in your portfolio. You're going to have to bring equities into play in some way, shape, or form in order to really supply that growth engine within your portfolio. Even then, returning 8-10%. Even on a balanced fund over time, that's pretty aggressive. So unfortunately, in today's marketplace, something that is going to return that much is just going to mean some level of return of capital within your payout.
Thanks, Mark. And I got a challenging question for you now. Staying with that ZBAL, the investor here, and thank you for investing in ZBAL, much appreciated. A question saying, well, it opened down nearly 2% on Monday, February the 1st. Like, what's going on there? And, give us some insights, please.
Sure, and I think you and I have talked about this a few times on these sessions. The importance of trading tips around ETFs, and not just ETFs, but the market in general. You know, you don't want to trade right on the open and close. That's where there's typically more market volatility. And you don't want to use market orders either. You want to use a limit order. All a limit order does is it takes some of the surprise out of the execution if there happens to be any, right? So, you know, you say you want to buy something at $10 as opposed to, you know, something that's outside of what your expected range would be. So limit orders are really important. But what happened here, I looked at this trade, is it traded right in the pre-market open. So at that point in time, obviously the underlying markets weren't open up. So there was an element of uncertainty as to you know, where all the underlying ETFs and therefore the underlying equities and bonds were going to price. So, you know, I really recommend to everyone not trading right on the open and not using market trades. Wait, even if you wait 10 minutes, that'll do it. And just make sure you use a limit order to make sure there's no surprises in your trading activity.
Thanks, Mark. Good example. Appreciate it. Staying with you still, Mark, here. This is interesting because, you know, an individual's asking around closing an ETF. And then, you know, what's that criteria around closing an ETF? I know you, as leading up the product initiative, you've certainly been through this in the past. What is it? Is it not enough volume, placement on an ETF? What's that thought process? And then ultimately, what does that mean for the investor who goes through that closing process?
Yeah, sure. This is a big question. So first of all, I don't think of closures as meaning there's an issue with the market. It just means something potentially didn't work out. But it's almost a good thing in a way that it means that providers are giving investors different tools and they're trying to come up with unique and interesting products. And unfortunately, not all of them succeed. So when you think about the criteria for closing, you know, these points here in the question are pretty valid. Not enough volume. Maybe the shelf has evolved over time and there's a different ETF that's better at what this thing is trying to do. Maybe the market has changed. So, you know, something can certainly fall out of favor to a degree that it just doesn't make sense anymore to keep it open. You don't see good prospects for that ETF on a go-forward basis. So how are investors notified? The ETF company will do a press release, which is something that goes out to all the dealers, which means it gets in the hands through the dealers of their various clients. The process to close the fund, I believe it's usually a 60-day window of notification, and then the ETF is wound up. And again, the money gets returned to those dealers who then pass it through to their clients. And generally that takes a few days after the closure of the ETFs, just because it passes through a couple of different hands. If you are holding an ETF that is in the process of closing, of course, you can always sell it on the exchange up until that termination date. It's still fully supported in the market, and you can see that. Sometimes that's easier if someone wants to redeploy in a quicker fashion back into the marketplace. So that's something you can always think about. I'd also point out at the end life of any product, whether it's a fund or an ETF, there's typically, or at least there can be, a final distribution as well, because it's kind of like a year end. Of course, if you sell your own ETF, you're dealing with your own capital gains. But again, if an ETF terminates, it does treat it like a year end. So there's a few extra complexities there. So if anyone is dealing with something like that across their ETF holdings, you do have the option to sell out on the exchange up until that termination. Thanks Kevin.
Mark. So what we have for another question for you now is, you know, tax season's around the corner. I think we're always going to be prepared. And this individual is taking a look at cover call ETFs, and I'd say ETFs in general, but let's just stay with cover call ETFs. how do you report income as cap gains or dividends? Walk us through that process, and I'll put up behind you too as you answer the question. I'll put up the what to expect during tax season document we have available out there. So walk us through some thoughts around how you report income, capital gains around the cover calls.
Sure, thanks, Kevin. And covered calls are an interesting one when it comes to tax. They're a little bit more complicated, but I'll try to keep it to the Coles Notes version. Of course, you will get some dividend income based on whatever dividends are paid in the portfolio. But the covered calls themselves generally are treated as capital. So that means you get capital gains treatment just like you do on buying and selling a security in your own portfolio, or in this case, within the ETF. What's interesting about it is the gains and losses from those call strategies get mingled together with the gains and losses of selling portfolio securities. So at the end of the day, you may end up with something that pays you some return of capital because it's got some tax efficiency between that mix of a gain bucket. But by and large, or at least on the BMO shelf, we pay out what we earn, which is the dividend plus the call premium less any expenses. So when you hold a covered call, you can expect dividends, and then on a year-by-year basis, depending on what's going on, you can expect some level of capital gains or potentially return of capital because of the call activity going on in the portfolio. Thanks, Kevin.
Thanks, Mark. And I know you're working on those things now for coming out. Distribution. It takes a little time for those people out there to get ready for tax season. Now, I know we had a few more questions on this. I'm sorry we can't get them all today. I did reach out to the team here at Prosper to make sure we get a copy of all the questions so we can answer them outside of the show. So we'll do that. I do want to highlight what we're going to talk about next week. So next week on February the 12th, 1 o'clock, our focus is conversations around clean energy. Now, Mark talked about earlier on about being one of the themes you're hearing about out there. We're certainly hearing some conversation in the newspaper on a regular basis around clean energy. So let's take some time and let's dive into that topic. Join us. We'll be some experts in the industry, S&P 500, plus some local experts too. So we'll dive into this next week and look forward to having you there on February 12th at 1 o'clock. Have yourself a good week ahead. Cheers.